The other thing that I would just probably emphasize is that stability today never means stability tomorrow. And I think that's something that is ingrained in me as a result of my experiences within the financial markets after the great financial crisis.
I'm Ethan Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Tiffany Wilding, who is a managing director and economist based in the Newport Beach office of PIMCO. She leads PIMCO's Cyclical Forum, crafts the firm's outlook for the global economy, and analyzes key macro risks for the firm's investment committee. Previously, she was a US interest rate strategist in two firms and a Treasury market policy analyst for the Federal Reserve Bank of New York, where she helped structure and implement the central bank's response to the 2008 financial crisis. Welcome, Tiffany. Thanks for joining me here today.
Well, that's great. Well, thanks for having me.
Let's start before we go into your economic views today, where you grew up, what you studied, and how you came to enter the financial world.
Yeah. Well, so I might have had a bit more of maybe a roundabout approach. So I'm from Louisville, Kentucky originally, and I thought I wanted to go into media. I was really interested in public relations and things like that. I went to a small liberal arts college in the Midwestern area that had a specific concentration and focus on media. And it was kind of a bit of a feeder for journalism and things like that later on. So I got into that, and my freshman year, I took a first economics course. And as a bit of background, I also just really liked math, and economics felt obviously more analytical, and it just really spurred my interest. So I actually switched majors, to one of economics and finance and business. And it sort of, springboarded me to ultimately my first job, which was in a buy-side investment banking role, doing credit research for a CLO. So, again, bit of a wonky path, but got me into finance, but ultimately got there and found a real passion for it.
I think it's really interesting that your first interests were in the world of media, because clearly that now shows in the work you do and your comfort level with presenting and media coverage. What do you think the skills that maybe led to your interest there, you've carried into your role as an economist? And I'm thinking things around communication, getting a message across, maybe distilling things into more basic terms?
Yeah, I think all of that. I guess when I was thinking about these issues or thinking about what I wanted to do back then, I really enjoyed to write. And I really liked reading. I also was an English major focus in addition to economics in undergrad. And I was really interested in writing, but just also more interested in journalistic writing as a result of that. So, obviously the first thing they teach you in journalistic writing is the inverted pyramid approach, but it's kind of getting your point across, in the first couple of sentences, don't bury your lead. But in addition to that, though, the journalist program that I started off in also had a broader focus than just print media. So they did TV, they did radio. So I was actually very much involved on campus with those different media pieces, obviously very early on. So I definitely have an interest in the media world. And that has, I think, really enhanced my ability to communicate messages, complex messages in easy frameworks of understanding for not only like my media appearances that I do now, but just for internal discussion and communication with our portfolio managers.
And then looking at your career path, which obviously has gone through so many interesting places, namely the Federal Reserve of New York in 2008, that clearly we've got to definitely have a dedicated question on that. Would you say there was any surprise in your career trajectory? Did it have a very natural course?
I would say every sort of twist and turn, if you will, has been a bit of a surprise in some sense, in that, as I mentioned, when I got out of undergrad, I went into a buy-side investment banking role. I was doing fundamental credit research in bank loan deals, and then I was in that role for a while, but then the 2008 financial crisis happened. And although the CLO world was relatively spared, the securitized products world more broadly was really crumbling around us at that time. And interestingly, the Federal Reserve needed people that came from that industry to help them understand the products that were blowing up during the 2008 financial crisis. So I saw the position on the Federal Reserve's website and thought it would be a less risky position to be in, probably a little bit more job security at the time. And so I applied for it. And they hired me with the understanding that I would have more intricate knowledge of the CLOs and other securitized products. But when I got there, interestingly enough, they put me on the Treasury market policy desk. And I was involved in actually implementing the large scale asset purchase programs, I guess informally known as QE. So we literally set up the auction style process to buy treasuries literally every day. We came in the office, as well as various other things. There was an alphabet soup of programs that were set up, obviously, during the 2008 financial crisis. Many of those programs were revisited more recently in COVID, but securities lending, swapping various collateral, anything that we could do to basically help clean up Treasury and broader funding markets during the 2008 financial crisis. We were literally trying to set these operations up and programs up overnight. So it was an incredibly dynamic and interesting place to be at the time. And I certainly ended up there more by luck, quite frankly, than by skill or anything like that.
And let's dive in a little bit to the takeaways from that crisis period, because clearly you were in an entity which was far from sleepy and civil service like at the time. It was actually probably rose to the front of the headlines and to the fore of really the existential crisis facing the financial sector. So what did you take away from that time, from both maybe a temperament standpoint, but also a lesson learned around the essence of financial markets?
Yeah, well, I mean, I ultimately was incredibly impressed with all of the colleagues that I worked with there, because trying to come up with frameworks for, we weren't, I guess you kind of were shooting from the hip in the sense that like you were having to literally develop these frameworks. But ultimately, there were very smart people that were getting together and very quickly setting up frameworks that ultimately lasted. And kind of in those darkest hours after the Lehman bankruptcy, in the 2008 great financial crisis, those programs that were set up were really tested throughout that period, and they lasted and continued on in that kind of state throughout the COVID period. And I'm sure that if there are other crises that result in serious market disruptions, that they'll be rolled out again. So, I mean, I think looking back, it's actually quite incredible how quickly these things were set up and how thoughtfully they were done, and how lasting that they've been. In terms of just personal lessons learned, obviously I learned quite a bit about Treasury market plumbing, securities, lending, plumbing, more things I learned about that than I probably ever wanted to know. Because one of the key issues that we were trying to solve for on an implementation team was we were trying to do all these things without causing market disruptions ourselves, right? So we were trying to reduce the effects of pretty severe market reductions in an as fair and systematic and efficient as way possible. And so when you really get to know these markets quite well and how the fixed income market more broadly just operates, when you have to set up programs to basically fix the problems that were literally happening around you. So I do have a lot of respect for all of the folks at the Fed that were working during this period. And just in terms of my own growth, just again, understanding the Treasury market really, really well set me up for a career in that.
Well, that's a good segue to where we are today, because not only is the Fed continually in focus, I think there's been perhaps a change of perception now, whether it's that it is certainly in control, commanding respect, ahead of the curve, as opposed to perhaps behind the curve, which was an allegation earlier. What's on your mind now? We can maybe start with the Fed in terms of interest rates. As you look to the last quarter of 24, what are you talking about as an economist at PIMCO? What are the issues that are coming to the fore?
Yeah, well, so I think when we just kind of take a step back and we look at not only where the US economy has come over the last several years since the pandemic, but broader economies around the world, other DM economies. Basically, what we notice, or what we could kind of summarize, is that across a range of different economic indicators, economies now look more like they did in 2019 before the pandemic than they ever have since we had those sort of series of very unique shocks. So if you look at inflation, inflation has come down quite a bit on a headline basis, as well as other underlying measures of core inflation. This was obviously a central reason why central banks increased interest rates. But we've had one of the fastest decelerations in decades after, one of the fastest accelerations. When we look at the labor market as well, some of those acute labor market shortages that were witnessed in the kind of darkest days of the pandemic, as you had a wave of retirements, you had folks that had increased caretaking needs as their kids were off of school or what have you, and they left the labor market. Those sort of severe labor shortages have also normalized to a large degree. When we look at indicators like job openings to unemployment levels, we're actually looser. The labor markets are looser in the United States than where they were pre-pandemic. And the other things that we look at, just the wealth transfer that happened, so as governments tried to support their economies during the pandemic, in order to give them that support, there were various programs that effectively transferred wealth from the government to the private sector. So you had actually direct payments to households. You had the PPP program in the United States, which was a direct support to small businesses. You had various other related programs that increased wealth and increased demand in the United States and in other countries. And those real wealth balances have now more normalized as well. In addition to that, when we look at, just supply chain pressures globally, those have come back down and are very normalized. So all of this is really to say is that, we're no longer in the throes of the pandemic, and now we look more normal. And as a result of that, when you look at monetary policy across the world, across the developed markets, it should start to look more normal as well. And we've seen central banks move towards normalizing their policy back down. There's this idea of that, within the economics field, that there's some level of an interest rate that's kind of more neutral for an economy. And central banks, obviously, it's very difficult to know exactly what that rate is, but central banks are probably above it now. And so we're seeing them now move to what Powell has called recalibrating monetary policy to the current state of the economy, which is much more normal. So I kind of see all this as a good thing. We're finally kind of moving on, and central banks are normalizing policy as a result. And it should help us, I would think, to stick the soft landing that central banks and other policymakers have been able to achieve.
And it's fascinating just to think about the range of topics that are now being talked about. We've got geopolitics, we have domestic politics, we have the impact of AI. And I'm going to then now turn to the work you do on the PIMCO Secular Forum. Many of these issues are all being talked about in the way that they perhaps work as a system. Can you talk about what topics are coming up there? And I'm thinking about maybe relationships that you didn't think about that now you have to think about, factors maybe that are now pivotal in there. And I'm thinking of things like, whether it be supply chains or outsourcing or the impact of tariffs. What are some of the menu of items that are coming up for that forum?
Yeah, no, those are all great questions. So I said that economies now look more normal than they have since 2019, but there's caveats to that, as you kind of suggest. And it does seem like the secular trends that were pertinent and prominent prior to the COVID episode were basically accelerated, I think, as a result of that episode, as a result of some of the heightened, geopolitical tensions that we've witnessed as well in the wake of that. And I would just really highlight, we've been very focused on three global transformations that we think are happening that each in and of itself are resulting in winners and losers. And when you have these transformations that, kind of result in losers, there's obviously potential for backlash. There's potential for more volatility. There's potential for potentially more inflation. And so these are all things that we'll have to navigate over our secular horizon. But just let me quickly just go through each of them and just give a quick summary. So I think the first and one of the most important ones is just this, and I highlighted it, or I kind of alluded to it when I talked about the rising geopolitical risks. But this move from a unipolar world that was sort of dictated, if you will, by the United States to a multipolar world order. And the implications of that, which have become more acute since the pandemic as a result of the supply shortages, the supply chain stress, et cetera. But the implications of that are this kind of reach for resilience that we've been talking about. So you have companies now that are more focused on not the most efficient set of solutions with their supply chains, but they're looking for more resilience. And they're doing that through building redundancies. There's a lot of discussion around the China Plus strategy, where maybe you're not moving your manufacturing out of China, but you're also building more redundant manufacturing elsewhere to create more resiliency. So, obviously this is, I think, also related to the political discussion in the United States that we're hearing around the presidential election. I think there's a very bipartisan view in Washington that trade relations with China are unfair or detrimental to US businesses and US households. And there's a big policy discussion around what the implications of that are and how that can be mitigated. And we've heard from the Trump side, the Trump administration, former president, of more sweeping and aggressive tariffs, where you've had on the Biden side, and I would think likely on Harris as well, you've had more of this focus on a high fence, kind of small yard high fence is what they've called it, where you have, very targeted programs that focus on key industries, high tech types of industries. And then you obviously have a focus more on multilateral pressure from our allies. But regardless, I think the broader point is that, these things are creating more macroeconomic uncertainty and I think more volatility. But just going on to the other transformations that we're focused on, the other one that I think collides with this to some extent is just the brown to green transition. So the need for more renewable energy sources, this is creating a new world order as well in terms of demand for energy. We've obviously seen some of the implications of this changing world through the sanctions on Russian oil after the Ukraine invasion and the implications for that for Europe. But, I think regardless, the fact that we are going towards this brown to green transition, is obviously important. It will continue to varying degrees across countries, and it will likely also create more potential for more volatile economic outcomes. And then just the final one that I would highlight is a digital transformation. And I think we've seen more of this, obviously recently, more potential impact from this with the advent of the large language models and AI, of seeing what these new digital technologies can really do and what they achieve. The capital that will have to be invested to literally fuel the electricity that will probably be needed to run the data centers and to generate, these types of programs, where I think we're just on the precipice of that. And as a result, the potential productivity gains that we get from these kinds of technologies. So all of these things are things that investors have to deal with. The period of great moderation, if you will, from the 2000s, we think that's very squarely behind us. And what we are going into is a world of more macroeconomic volatility that will be tricky for, of course, policymakers and investors alike.
So in terms of things that you think, that the famous words of things are different this time, are you, whether individually or in the forum, considering that certain things have just changed for good in a certain way? And I'm thinking of things like maybe the information cycle or the shortness maybe of a business cycle. We can see how markets have responded to events and how quickly perhaps some events have been sort of discounted in. We're seeing a resilience in markets around geopolitics, maybe domestic politics, as well as maybe the size of the budget deficit. Do you think that there are certain ways of doing things that are just have changed now and that we can, because there's a certain fundamental change?
Yeah, I think those are really good questions. And I would really maybe put it down to two things that are very interrelated. But I would say if you look back into historical recessions and kind of the economic implications of historical recessions, usually you have a period of, overexuberance in some area that causes a rapid level of growth. But then there's overextension. There's credit that is provided that, maybe at terms that are much less stringent. And you have a sector that's effectively overextended, and that sector has to contract and has to come back. And that is the recession. This recession was very different from that. And of course, those historical recessions where you have some sector or some agent that's overextended, Once the market figures that out and you have that pullback, that obviously has implications for the holders of those assets and the balance sheets of those assets. And that's a long-winded way of saying is usually you come out of a recession needing to repair balance sheets on the corporate as well as the household sector. And that just didn't happen in this recession. And it was because of just the extreme government response to the pandemic that you actually had a world in which households and corporates came out of this episode with a better balance sheet than they went in it. Many people paid down debt with the government programs, the government transfers that they received. And as a result, you've just seen this resilience across investment, across consumption. And this is happening not only in the United States, but elsewhere across the developed markets. And that's very different than what we tend to see, which is more vulnerability right after a recession. So I think that's something that can be more ingrained and more longer lasting. But of course, the flip side of that is all of that wealth transfer had to come from somewhere. And the economic agent that it came from was central governments. And the United States in particular, in terms of its outlook or trajectory for government debt in the future, worsened quite a bit as a result of the pandemic. So the balance sheet that was weak, or the weak balance sheet that came out of this was a federal government balance sheet. Now, other developed market countries have made moves towards more austere government involvement and spending since the pandemic. They've had government debt levels that have come down on a real basis, deficits that have returned to more normal, and of course, the United States is very much an outlier from that. We've had structurally kind of what look to be 6.5% to 7% deficits relative to GDP come out of the pandemic, and a trajectory of government debt to GDP that looks like it could reach 200% of GDP over the next several decades. So the United States, although we are certainly better now, just from a private sector balance sheet perspective, over the long term, or even the medium term, at some point, US fiscal policymakers will have to make tough decisions to get us on a more sustainable debt trajectory. And I think the question is, when will that happen? When will policymakers have the courage to do that? And if you look and listen to the presidential candidates for the next 4 years, neither Trump nor Harris are really running on a platform of correcting and redirecting the US debt trajectory and profile. And really, you have to make hard decisions around Social Security and other programs like that no one really wants to make. So we kind of view this as a kick the can down the road thing, but eventually it will have to be dealt with head on.
And then just a slight kind of a different question from what's on the mind of the Secular Forum. The clients you meet with, have you found that clients' priorities in terms of what they want to hear from has changed? And just to give the context I bring is I still think there's a lot of appetite to discuss the economy, the election impact, and macro issues that perhaps are a little bit removed from the portfolio reality. But, the strength of the dollar, all these macro issues, there's still a real hunger to discuss them, I see among clients. How are you finding clients' appetite for these kind of discussions?
Yeah, I agree. I think the appetite to have these kinds of discussions is potentially bigger than it's ever been. We talk a lot about macro issues, but we also, I think one of the bigger things, and of course, maybe you'd expect this coming from someone that works at a large global bond manager, but one of the other things that we've really focused on and we really talked about is just the level of bond yields right now, still globally, looks to us like it provides a lot of long-term value. And especially when we compare that to valuation measures for riskier assets, when we look at credit spreads, which are historically tight. If you look at equity valuations, equity risk premiums, they're also incredibly tight. So comparing that to bond valuations, because you've had central banks that have had to get policy into restrictive territory, it's effectively been a gift for bond investors, at least looking forward. So one of the biggest conversations that we've been having with our clients is that just given these initial conditions in valuations, if you're a longer term investor, should you still have the traditional 60-40 equity bond portfolio allocation? Or do these types of valuations and what could be equity-like returns for owning bonds actually suggest that you shift that to a 40-60 portfolio allocation? And, I think that kind of conversation, has also really resonated with people, and again, now that central banks are starting to reduce interest rates and they're no longer kind of single mandate central banks solely focused on inflation, but they're also now focused on the growth side of their economies. That's resulted in the correlation between that negative correlation between bonds and risky assets coming back. So you're effectively getting an asset that has relatively elevated starting yields, has a portfolio protection, is a good hedge to your risky asset portfolio, and has pretty high levels of liquidity, by the way. All of that seems to be a pretty good proposition for owning safe, high quality bonds here.
And now just to change gear completely, because I wanted to get back to one of the original purposes of this podcast, and it's around tracking diversity in our industry and the careers of people and how they develop in it. And yeah, I'd love to get your perspective on that, given that clearly this is going to be a factor, I'm sure, that factors into the forum, the secular forum as well, given it is, you talked about sustainability, and these are all factors that will affect global balances. Any thoughts on the diversity in our industry and any grade you might give it and any progress you see?
I feel like that's a little bit of a loaded question because I think the finance industry historically, and I think this is still the case, has suffered from less diversity in terms of socioeconomic, racial, even gender diversity. But I do think that certainly the industry, I think, is working more towards getting to a better place in that. And what I would just say is that here at PIMCO, we focus a lot on various aspects and lessons from behavioral finance and behavioral science. And one of those lessons is that having diverse and uncorrelated viewpoints is a very good thing on committees, on investment committees. And we try to do that with how we devise our investment process here. We always, at every juncture, we don't want to have the most senior person in the room always speaking. We don't want to have the most outgoing person in the room always speaking. And so we really try to set up a process where voices that do potentially have an edge, but maybe would have been unheard in a process that was not more thoughtful about these things, we really try to bring out those voices in various ways. We do it through surveys where we can see who the outliers are. I chair various committees where I survey people ahead of time, not only to make them more accountable to the issues that we're going to talk about during the meeting, but to kind of see where consensus is during the meeting and to make sure that the folks that are out of consensus do get a sufficient amount of airtime so we can see what we can learn from them. And so I would just really, I guess, underscore those kinds of practices for anywhere. They're easy things that people can set up to make sure that even if you do have just more diverse people sitting around a table, you want to make sure that they're heard and that their opinions are being incorporated. And these are some easy ways to make sure that that can happen.
And just related to your own career, looking back, have there been any highs or lows so far?
Well, I was at the Federal Reserve during the financial crisis, and I left in 2011 and I joined Morgan Stanley. And this was still a pretty tumultuous period for the financial markets and for banks in general. And I know when I joined Morgan Stanley, there were what they called rifts going on, were basically like sort of layoffs I want to say every 6 months. I want to say 3 months after I joined, the gentleman that hired me was actually riffed. And so we had kind of a new leader for our group. And the Morgan Stanley stock, I want to say, halved when I was there. So it was just like a very tumultuous time to be at an investment bank. And then I moved on from Morgan Stanley and I was at a macro hedge fund. And as many people know that have worked at macro hedge funds, things can turn very quickly. Views can turn on a dime as well. So I was hired there to do research and to think about and to set up sort of systematic trading strategies using macro indicators. And it became very clear after I was hired there that there was a lot of enthusiasm for that kind of project in the beginning, but then enthusiasm sort of quickly waned. So I guess what I would just say is that, in many of the roles that I've been in, it's been in places that, are tumultuous, that are changing literally as you're sitting there. And so I think it gives you a lot of perspective and also gives you some appreciation when things maybe aren't as crazy. I've been at PIMCO now for 8 years, and it's not to say that things around here are not tumultuous year in and year out, but luckily, at least my role has been a bit more stable. But the other thing that I would just probably emphasize is that stability today never means stability tomorrow. And I think that's something that is ingrained in me as a result of my experiences within the financial markets after the great financial crisis.
I love that. And you've kind of answered the setbacks and challenges question right in there. I think it's really important that you said that because that is, I think, clearly the rough that goes with the smooth of a financial services career. And I don't think really people are taught about it when it comes to, say, business school or the undergrad route, but it is a life skill dealing with that volatility, maintaining perspective, maintaining one's options open. So I'm sure there's a wealth of career advice you could share based on that. But thank you for openly admitting that sometimes these things are not exactly a walk in the park, some of these work environments. Staying on the personal reflections here, looking at the course of your career, have there been any particular people that have been mentors or sponsors for you or that have guided you or otherwise been impactful?
Yeah, I think you want to find the people that can mentor you and teach you. And those are the people that you really want to focus on working for. And I was lucky enough to have two very good managers and mentors. One of them was actually a direct manager at Morgan Stanley when I was there, who was quite amazing and very influential. And we still are quite close today. But the other one was actually, so he worked at Morgan Stanley. We overlapped. I didn't work directly for him. But then when I came to PIMCO, he was my direct manager. And both of them, I think were very even keel, very, very fair, and very thoughtful in their approach, not only to economics or interest rate strategy, but just also in terms of their management style. Neither of them were micromanagers. They allowed me to kind of be entrepreneurial in the role with the given. They kind of gave me broad brushstrokes in terms of what we were trying to achieve, but certainly let me operate with an entrepreneurial spirit, just given those kind of broad-based goals, and have been very supportive throughout my career. And I definitely think that you need those people. You just need people that you have a good relationship with, that you can level with, that sort of understand where you're coming from. And I do think that you need some at least good chemistry with the folks that you work with because you see them every day. And you really, I think, have to, kind of both understand where each other is coming from in order to maximize your relationship and therefore your work output.
That's really well put. And I think also it is an argument for having some mobility in your career because you're not going to get the ultimate chemistry in every setting. And I think
Right.
Having broader groups to work with. And it's interesting that the lack of micromanagement, I sometimes think the greatest leaders rarely are micromanagers. They certainly will be able to trust their employees. So that's really impactful. And then just my last question is around any creed or motto you live by or any word of wisdom that it was imparted to you or that you've developed alone to share with us now.
Yeah, I mean, I think ultimately this is why I have probably a career in bonds. But I think I'm always in life just kind of running through scenarios and thinking about different risks and being open to new opportunities. And I think that's been my career as my title is economist now, but I've been in interest rate strategy. I did work for the Federal Reserve. I also did credit research. But I think throughout my career, I've tried to be incredibly open to the opportunities that present themselves to me, at the moment, while also having a bit of a longer term, kind of a 5-year, this is kind of where I want to be in 5 years, but being open to the more specific opportunities that present themselves. And then just trying to work hard within those opportunities and seeing what I can learn from and from whom in those environments that I'm in and try to maximize them. And I'm always asked, I'm on panels for undergraduate students or even graduate students. And that's been one of my key things that I've always suggested to them is just try to learn as much as you can from who you're around and try to leverage that and remember it throughout your career.
Wonderful. Well, your career now and your title now, I think, is definitely an enviable one. And then when it comes to dealing with the intellectual giants on the secular forum, they are nothing short of a dream team of, I think, luminaries. So thank you so much for giving us a little snapshot of some of what's on the mind of that forum, as well as for taking us through your own career. Thank you for coming and sharing your insights with us.
That's great. Well, thanks so much for having me.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.